All right, Jimmy, how you doing?
I'm doing great, Jeremy. How are you?
Doing fantastic. Thank you so much. Well, we're doing another market insights. This one is for Q3 of 2023. So let's get right into it. The big points here, and certainly not the only points that we're going to be making today, because there's a lot of stuff here and a lot of really interesting things to discuss, but we're going to talk about how tech is flying high, a lot of it driven by AI.
Yep.
Talk about currency moves, the US dollar, how that's playing out.
Right.
And the yield curve and what that's starting to show and tell us. All right, we'd like to begin the discussion with a little bit of a risk reward dynamic, right?
Yeah, I mean, forgive us for being boring here, but I think every conversation around investment should start and end with this point, which is the investment allocation that you choose, the asset allocation is the most important decision you make. Regardless of tech flying high, dollar movements, interest rates, the most important decision to be made is how you're going to allocate your portfolio. And we at OnTrack believe very strongly that building a comprehensive financial plan that provides education and some valuable insight on the impacts of risk and return from the asset allocation, you build a plan that can educate you around that. That's the most important an effective way to create some clarity on what allocation is right for you.
This anchors us. This anchors our decision making.
Yep.
This helps us determine how we're going to move forward with a financial plan.
Correct.
And the asset class returns are indicative of really the performance of how somebody might perform on a 60-40 basis here. So what you're seeing with the dotted black line in there, this doesn't change a whole lot month or quarter over quarter. It's really
Right.
more of an annualized piece.
Right.
But as you can see, the asset allocation is kind of a middle of the road performer.
Right. So 60-40 meaning 60% of your allocation to stocks, 40% of the allocation to bonds. I think the most important point you look at here, the last two columns there, which is that the white, the asset allocation return is above the average. At the very far right column, the volatility, it's well below the average. So it's proven to be a very strong allocation for many.
Absolutely. All right, we're going to get right into it. So the hot topic, as everybody's been talking about for the better part of 2 years now, is inflation.
Yep.
Well, here's the deal, right? Now we've got really good data year over year. We saw a year ago in 2022, June of 2022, we reached the peak inflation over 9%.
Yep. That's a precipitous drop, right? For 12 months.
Massive.
I mean, that really is. I think it's important to, the gray shaded area that you see back there in 2008 is a recession, right? Mm-hmm. And so, we don't proclaim to be, expert economists here, but typically what you see from an economics perspective is when you have a recession, severe like it was in 2008, the Federal Reserve cuts interest rates to stimulate asset prices and economic activity. We sort of muddled through the road there for quite some time without having the inflation that the Federal Reserve is looking for to that which would give them the clearance to start to raise interest rates to calm down inflation. So it took a long period of time to get the inflation that the Federal Reserve was looking for. And then I think we got more than what they had hoped for in a hurry last year.
Right. There's always a lagging effect with all of the movements that the Fed performs.
Sure.
And so where we are right now, and we'll talk about this later when we get back to the fixed income piece, but just to preview a little bit of that, we're nearing the top of the rate hiking cycle.
Sure seems like it.
It sure does. I mean, that doesn't, we can't tell you exactly what Chairman Powell is going to do. Right. But we do know that we're near the height. And what does that mean? That gives us a lot more confidence in equities. Right. But it also has bolstered the fixed income piece in a pretty big way.
Sure.
All right, getting into the S&P 500. Folks, for those of you who've been listening to all of our previous quarterly updates, the S&P 500 is sort of our main go-to benchmark when it comes to the equity side. These are the top 500 companies in the United States of America, and they drive a lot of the performance, and they are a great benchmark for understanding how the market is acting and performing.
And when we start to think about what does the market look like, when somebody were to ask us, so what do you think about the market? A very good starting point for identifying what does the market look like is the current price to earnings ratio, right? This is the valuation, the starting point of the valuation of where the market is at. And so what we see from this chart, that the takeaway here is we're at 19.1 as of the end of June. We're at 19.1 of the forward earnings, and the 25-year average is just under 17.
Yep.
So we're slightly above the 25-year average, but we're still within one standard deviation of that 25-year average. So getting more expensive, as you can see the gray bar there moving up off of the 25-year average,
yep.
But still not anything that is excessive relative to the long-term norms.
Yep. And quarter on quarter, you're seeing these changes. For the year, we started the year at about 16.5, and now here we are, plus 19.
Right.
So the trend is not surprising. It's kind of what you would expect with the market that's been doing what this market has been doing.
I was going to say, absolutely. If you've been invested in it, you've been enjoying the increased valuation.
Right. So we've also had this slide in here before.
Right.
The PE ratios and equity returns. We're going to look at this on a 12-month basis, and then we look at it over a multi-year basis, right?
Yeah, so this is so important because, again, you come back to the original question, what do you think about the market? Well, valuation is a very important starting point, but it's important to note that the returns that you can expect in the next 12 months, they have very little correlation to the valuation point, presently. Now, that being said, with the benefit of more time, and you give yourself a 5-year outlook, you can see that the dots on the graph on the right there tighten up quite a bit. And that R squared number is basically effectively the correlation that you can tie to the current valuation, and that number jumps up quite a bit as opposed to looking at the short run in the next 12 months.
People might ask the question, so okay, now if I'm looking at the S&P 500, do I want to buy when it's 19 times the forward earnings? Is that it's above its average? Is that a good time to buy it, or should I shift to something else?
Yeah, that's a great question. And again, I think the answer is it depends. That's always the answer, right? It depends on what else are you holding, what does your allocation look like, what type of account are you buying in. But look, we're still below. We're still within one standard deviation of where we're at, and
right.
It's hard to imagine not wanting to have some allocation to the 500 top companies in the United States that have some of the brightest minds working to navigate all the inflationary hurdles, the Federal Reserve policy hurdles that might come their way. These are very dynamic companies with a lot of very smart people working to take advantage of the potential headwinds, but also those that might be potential tailwinds for them.
What I really picked up on in there, among other things, is dynamic companies, right? And what you have to realize that these are living, breathing human beings who are running these companies,
right?
And they are reacting to things in real time. They're making innovations. They're changing the script as need be in order to be successful in whatever the environment might be.
Absolutely right.
This is really interesting here. So on the left-hand side, what we are showing is that the top 10, okay, so we'll color code it for you real quick here. In green, it is the top 10 companies in the S&P 500 and how they have been valued. If you look around the 2000 mark there, they were extraordinarily highly valued, right? So, and that was the tech bubble that we kind of, it's a long time ago, but it really did happen, and it was a massive overvaluation to certain companies.
Right.
Now, things came back down to earth for many years, and then if you go to about 2020, we had obviously COVID. That also created, that put a lot of money into those top 10 holdings within the S&P 500. And that has again been exacerbated by the advent or the popularity of AI.
For sure.
in recent months. So that's kind of what we're seeing here on this chart. Any other thoughts on what we're talking about there in terms of what that means to folks?
I think so. Going back to your previous question, like, would you invest in the S&P 500 right now? One of the elements I think that would give you confidence is, yes, the top 10 stocks have become very highly valued within the index. But when you look at the remaining stocks, they're only at 113% of the average, right? Whereas the top 10 are substantially higher. There's a lot of breadth underneath the top there that can be very resilient and supportive of the forward movements of the index.
Right, absolutely. So moving to the right-hand side of this, you see that, okay, those top 10 stocks, they do represent over 30% of the total market cap.
Right now, so we got to remember, maybe we'll have to do a piece on this in the future as far as like the way that the S&P 500 is constructed being a market-weighted index versus a price-weighted index like the Dow. But that's part of the beauty of owning an index investment strategy is like allowing those companies that are going to become the next best of breed in their sector, allowing them to grow into a larger portion of the overall index. Picking those companies ahead of time is a very difficult task. But yeah, so you look, you're at about 32% is the total weight of the S&P 500 in the top 10 stocks. So it's certainly something that we keep an eye on and understand when we see movements in the index, what is likely the main cause or where's the attribution directed to.
And so one of the questions out there could be, are we in for another tech bubble?
Right.
And I tend to think the answer is no. And part of the reason why I think the answer is no is look at the earnings contribution of the top 10. They're at 21%.
Yeah.
And so it does tell you that some of the earnings are more evenly dispersed among those 490 other companies.
Right. Again, yes, we have had a concentration of investment into a lot of these names that we know, the Apples, the Microsofts, the Amazons of the world. But again, there's 490 other companies in this index that appear to be, based on the bottom right chart, carrying their weight from an earnings perspective.
This is related. It's different but related. So in this chart, we're showing you the Nasdaq Composite in purple and the Invesco Qs, as they're called, QQQ Trust. That is the top 100 companies in the Nasdaq, and then comparing that to the S&P 500. So what you're seeing here is the outperformance of the Qs and those top 100 companies in there. Now, who are those top 100 companies? There's a lot of overlap, right? So at the end of the day, reason we're showing this to folks is that the Qs are being rebalanced shortly. And why is that? That's because of that heavily concentrated capitalization within a handful of stocks.
Right.
The top 7 stocks there represent over 50% of the total capitalization. Crazy.
Right.
2 of those stocks, Microsoft and Apple, represent 25%. So it's a little wild, and it's nice to see that the Qs are getting rebalanced, so they take away some of that over concentration risk out of the benchmark.
Right. And I don't think we believe this is like anything that is going to is reason for a total like shift of investment philosophy, or is a huge investment opportunity at the moment. Maybe a trading opportunity for some, but from a long-term investment perspective, we still look at the index as a great place to be for the long run.
Agreed. Yeah, I agree with you wholeheartedly. It's going to create some waves, but it's not going to create any monster, perfect storms.
Right.
All right.
The magic trick.
This is the magic trick, and excuse our funny little blue box here, but it's covering up the top end, and that's for a purpose. These are the annual returns and the intra-year declines. So the declines are on the bottom part of this chart, and that's what we want you to concentrate on right now. And I think that the reason why we want to do this little magic trick with folks is that we want to show that this negative bias that people have around the markets going low and then going lower and possibly just tanking, it's a real psychological bias that people have.
No question.
And it's related to consumer sentiment and this pall of negativity that's been over the markets and people in general for the better part of a year.
Sure.
We've all been talking recession for better part of a year, and
Right.
it just seems like it's not happening, or it hasn't happened yet, or if it has, maybe it's already happened. Who knows?
Right.
So, talk to me about what you see here in the red.
So again, what we're looking at here, this is the S&P 500 going back to the last 43 years. So we're going back to 1980 here, and what you see in the red dots are how much in each calendar year did the S&P 500 drop in price from a peak to the trough of the year.
So top to bottom.
Top to bottom within that calendar year. And what you see is there's a lot of red dots. There is volatility. Markets don't only go up, even though the prevailing trend might be up. Within any calendar year, you're going to get quite a bit of volatility. In fact, over the time period we're looking at here, 43 years, your average intra-year decline is over 14%.
Mm-hmm.
So highly normal to have double-digit
drops
every single year.
You're gonna feel some pain.
Right.
Okay. So then on the top here, we magically reveal to you the actual the earnings that you've seen, the growth that you've seen in each of these years since 1980.
So yeah, this is what you've actually experienced. This is what you want. You want the growth. You want the positive returns and the growth of your assets. You have to be willing to live through some of the volatility and turmoil in the immediate future to earn and receive these robust long-term returns. So again, we have over a 14% average decline during each calendar year. However, in almost 80% of the calendar years going back to 1980, we have a positive return in the market.
It's a really interesting take on how the market behaves. All right, we're going to shift our focus a little bit, talking about that value versus growth, relative valuations. This hasn't changed a lot quarter over quarter, to be honest, right? But we wanted to put it in here to show people, what's going on. And basically what the chart is telling us is that value stocks are cheap, and they've gotten just a little bit cheaper.
Certainly relative to their growth counterparts, right? So yeah, you see the growth stocks are over 27 times their current forward earnings. Value is less than 14.5. And in addition to another very important component that we talk about with clients quite a bit are dividends. When you look at the dividend yield coming out of them, these tech growth companies typically don't pay you out a large portion of their earnings. They tend to reinvest them in hopes of future greater appreciation. But some of the more mature companies are willing and able to return a good chunk of their earnings to the shareholder in the form of a dividend. And so, you're looking at a dividend yield right now of, you've got a large disparity there between the value and the growth that makes the value stocks potentially, more appealing from an income generation perspective.
Yep. Value is an important part of portfolio construction, just like growth is an important part of portfolio construction.
Absolutely.
Right? You can't have one without the other, in our opinion. It's that balancing act. All right, we are now moving our attention to the US dollar. We kind of talked about this as a theme at the very beginning. And so, again, just setting it up here for everybody, the orange is the 200-day moving average of the US dollar. The blue is the 50-day moving average, and purple is the actual dollar.
Right, exactly. Yeah, and so this is important to remember that we're looking at the last 12 months. So we're filming this here on July 20th. This was run today. So we'll go back to the last 12 months. We've talked about this in prior episodes, but you can see in November of 22, that was when the dollar broke down below both the 50 and 200-day moving average, which is an important point to reference. It has maintained and stayed below both. It stayed well below the 200-day moving average, and it has also stayed below the 50-day moving average. It has come close to retesting and going over that 50-day moving average, but it has ultimately broken down after testing that threshold there. And here you are now still well below at the current moment, well below the 50 and 200-day moving average.
And the implications here are many. One of them happens to be that a weaker dollar gives more benefit, more tailwinds to international
Exactly right.
equities, and but it doesn't necessarily hurt the domestic companies either.
No, I mean, like, look, you've been dollar breaking down this year. It's good for U.S. company earnings as well. Particularly exporters.
Mm-hmm.
This gives other overseas companies more purchasing power as our dollar weakens. So it clearly hasn't hurt us as the U.S. has done well, but it is theoretically more of a tailwind for international stocks as opposed to U.S.
All right, broadening out the look. Now we're looking at all the different major benchmarks out there: the S&P 500, Dow Jones, Nasdaq Composite, the IFA, which is international developed, and then the emerging markets. Mm-hmm. So you're starting to see clustering,
right?
Now. And you were kind of seeing some outliers a little bit more. Sure, emerging hasn't performed quite as well as everybody else, but the others are starting to cluster.
Absolutely. So again, this is going back to the last 12 months. So here we're on July 20th. This is the last 12 months performance. So not to get these numbers confused, but what you'll see is the internationals were leading the way for quite some time. But in the last month or so here in the U.S., those tech stocks that we talked about in particular that that are included in the Nasdaq Composite and make up a large chunk of that have really taken off in the last 2 months. And now they're slightly outpacing the international counterparts. However, that being said, over the last 12 months, the international stocks are still outpacing our broader-based S&P 500 index by 1%. So an important point to note in looking at the construction of your portfolio: how much international should you have? Do you have? Here's a good look at how they've all performed in the last 12 months.
And you guys have seen this slide before. It's the cycles of U.S. equity outperformance versus that of the international markets. And again, these run in what appears historically to be multi-year cycles. Where we are exactly right now, you could make an argument that we're on the cusp of one of these purple international outperformance phases versus domestic. But it's tough to say. You get these bursts of energy like AI coming in and giving a ton of energy to the S&P 500, and it's sort of leaving the international markets in the dust for the last quarter.
Right. Yeah. Exactly. I mean, again, I think the overall my big takeaway from this is the importance of diversification. Mm-hmm. Okay. Yes, the U.S. markets have been the place to be for the last 15 plus years. But you keep going back all the way back to 1971 here, you can see that there is a cyclical nature to the outperformers. And we've seen over the last 12 months now that the U.S. has outperformed the S&P 500. So something to keep in mind when you're building the overall allocation.
And why do we still remain bullish on international? Well, this is one of the main reasons, right? So on the left-hand side, you see the price to earnings discount versus the U.S. So if you're on average, you can buy international stocks at 15% less than what you would buy the domestic stocks.
The chart on the left is basically illustrating our home country bias, mm-hmm. right? The bias to buying where you live and buying U.S. Allows you to typically, on the average here, buy international stocks 15.7% less than we buy U.S. stocks. However, we see that we are now more than twice that level of a discount. You're almost 33% of a discount buying international stocks relative to U.S.
So it's a clearance sale on international right now.
I mean, you're almost 2 full standard deviations. That's a big number statistically.
Yeah. And it's a clearance sale, and it's not one of the going out of business sales, right? It's not like that, and they're not closing up shop in Europe, right?
When you start adding these data points together, the currency movement, the discount of the international stocks to the U.S., I think it creates a compelling discussion, at least, for how much international does one have in their portfolio.
Exactly, and then to further that discussion point, the dividends, the dividend yields on the international are 150 basis points higher.
Yeah.
So again, that's real money. That's 1.5%, right?
Yeah, again, your two standard deviations the other way.
Yep.
With it, more dividend income being produced. These are very important data points to consider when building your portfolio.
All right, again, we're going to switch now. We're talking back again about inflation. Well, actually, we're not. We are indirectly talking
Yes.
about inflation, and we're talking about the Fed fund rates. So this is showing where we've been since 1999. So folks, remember that we're not in new uncharted territory with rates at 5.25%.
Right.
We're going back to where we used to be, yes, but it's not uncharted territory.
I think most people would admit that having some cost of capital is a good thing in the long run, not having money being free, right? Because I think things tend to get distorted from a price perspective when that's the case. But what's interesting here is to see the green dots are the market expectations. So this is looking at Fed funds futures rates versus what the Federal Reserve has released from their meeting minutes as far as like their dot plot of what they expect. And so you do see some divergence there. So it's less so than what it was or had been a few months back, but there's definitely still some divergence of what the market expects the Federal Reserve to do and what they are telling us they will do. So I think the more important point here though is like the FOMC's long run projection is that purple dot there at 2.5%. So again, if you think about where we're at from an interest rate hiking cycle perspective, it appears as though we are closer than not to the end of this rate hiking cycle.
That's right. Which is an important data point for when we start to talk about things like fixed income.
Absolutely.
So we've also used this slide in our previous quarterly reviews. What you're seeing here is the U.S. Treasury yield curve. And I think the interesting thing about this is before we had all of our focus on that very front end of the curve, which it's not as if the focus shouldn't be on that. But what we are seeing in the trend is that things are tightening up now. As you go out in time, you're starting to see a convergence between where we were at the beginning of the year and where we are at the end of Q2. Your rates are starting to align a little bit more.
Right.
It tells us the curve is flattening a little bit on the long end.
Yeah, exactly. Again, now you're only seeing a real divergence here in the very front end of the curve. Still not the normal sloping yield curve that you see illustrated with the gray bar below.
Still inverted, right?
Still inverted, but certainly noteworthy of where we're at. But again, when you start thinking about that duration piece of a fixed income portfolio, it's definitely starting to look more appealing at this point.
Correct. So when you're looking at fixed income now, you say to yourself, you go back 6 months ago and it was like, let's stay within a year or less on duration. Right. So now we're starting to say, you know what, I think you can go into that midterm cycle. We're starting to get some folks as far out as 10 years now,
right,
and we're feeling comfortable with that.
Yeah, absolutely. Again, it looks great that you can get 5.5% right now, but how long can you continue to keep getting 5.5%?
Exactly.
At some point, if rates are cut like they were forecast in the prior slide, you have real reinvestment rate risk. And maybe those rates dry up, and then all of a sudden the 10-year number you can get today is not the 10-year number you're able to get a few months from now, and that might not work in your favor.
You always do a good job of saying this. Fixed income is supposed to be boring. It's supposed to be simple and boring, right? You don't want to miss the boat, though, because you were looking for the absolute best rate that you could possibly get.
Right.
And it's fleeting, right?
Absolutely.
And so there's opportunities here to lengthen out that curve or the duration and really start to look at how can you build a plan for fixed income, not just for the next year, but for the next 5 and 10 years.
Absolutely. Well said.
All right, we're going to sum it up. First 6 months, so Q1, Q2. I mean, what can you say? It's been a strong year so far.
On the heels of a very poor year, right? I mean, like last year was not particularly fun. You had interest rates rising, you had inflation that was high, so they raised rates to combat inflation. Equity prices come down, bond prices come down. It was not a particularly enjoyable year in any markets last year. difficult to get very bullish on the market on the heels of that. But look at what we've experienced in the first 6 months.
The Nasdaq is plus 32%.
Right.
I think that's the best first 6 months of performance that it's ever posted.
That's incredible.
S&P's up 16.
Right.
That's obviously fantastic. Dow's up 4. That speaks to a little bit of that reversal of what was working last year is not necessarily working as much this year, right?
Yeah, exactly. Last year the value stocks held up a lot better in the face of these big time declines. Now the Nasdaq was down over 30% last year.
Right.
Right. So we're up 32% year to date, but it did draw down over 30% last year. So important to know that the Dow was not down as much as in 22 relative to the S&P and the Nasdaq, only being up 4%. So again, yes, that reversal piece as we got highlighted here. What worked last year, relatively speaking, not working as well, relatively speaking, this year.
I think it's worth mentioning emerging markets have been underperforming. They're at 3% for the year.
Yeah.
I think a lot of that goes back to China, doesn't it?
No question. I mean, they're always a huge wild card in the overall investment landscape. I think it's interesting when we talk to some of the investment management companies that we work with and partner with. There still is a lot of bullishness in the emerging markets in the long run. But again, you think back, they haven't done as well. They're lower valuations, maybe justifiably so at this point. But over the longer term horizon, I think there's a lot of opportunity, especially when you add in some of those other variables that we talked about with a weakening dollar. Maybe inflation coming down, bringing asset prices down. It's an intriguing spot to be, but again, I think that the most important point, getting back to what we started with, though, is like the size of the bet in emerging markets, right? Like how much of your chips are really on in the emerging market space.
Right.
You typically don't see anybody with a very large allocation there, but the developed markets being up over 10% in the first half of the year has been a very nice return.
It really has. And we've talked about the fixed income, right? So it's just it continues to be interesting. It continues to be a place to invest in.
Yeah, again, it's been boring. It was kind of like something that wasn't talked about a whole lot for a decade when they had this zero interest rate policy. There wasn't a whole lot to be had from fixed income. Now there's a lot more attractive yields and returns to be had, and it can start to get back to being what it's supposed to be, a boring sort of a ballast position in the portfolio.
Yeah. Lower risk yield is now a true opportunity inside of this market, and it appears as though it's going to stick around for at least the near term.
Let's hope so.
All right. That's all we have, folks. Thanks again for joining us on the Q2 2023 Market Insights. Thank you so much.